Good morning, everyone, and welcome to today's ARENA webinar in conjunction with Connexo. Thank you very much for attending. I have to say, I hope everybody is keeping well and keeping safe at the moment in these circumstances that we have. What we're going to talk about today is we're going to discuss upcoming FCA changes to regulation within motor finance. And I'm really pleased today that we have with us an expert guest joining us from Connexo. So my name is Neil Maud. I'm Director of Technology at the ARENA Group. Just waiting for the next slide to come through. I'm in the bottom right of this slide there. That's me. ARENA Group are a provider of document management technology to a number of industries, including automotive and also the finance industry. And I head up our software division, which delivers those document management solutions. We also do consultancy, copy print solutions, and some outsourced document scanning as well. So we have a range of solutions around document management. I'm joined today by Yasin Sridhar from Connexo. And I'm just going to invite Yasin, if you wouldn't mind just introducing yourself and saying a little bit about Connexo.
Thank you, Neil. Yeah, hi everybody. I'm Yasin Sridhar. I'm a regulatory director at Connexo, a division of Evershed Sutherland. We are the alternative legal service provider arm of Evershed Sutherland. We work a lot with financial services firms to help them understand regulatory expectations, whether they're set by the FCA or the PRA, European initiatives, as well as understand the impact it has on their business. We offer tech-enabled solutions to help firms with managed service as well as legal service, and we also offer company secretarial, HR, and interim resourcing support.
Okay, thanks, Yaz. We also have Gillian Murray, ARENA's marketing manager, on the call today. Gillian will be keeping an eye on the discussion panel, and it'd be really great to get your questions and comments on there. So please do post those. We have a section later where we'll be coming back to those, and it makes the session much more interactive and much more valuable to everybody if you can get your questions in, please. Put the agenda there on screen. We've done the introductions. Okay, so you know it's been myself and Yaz talking on the call today. I'm going to talk about just a little bit of setting the scene in a moment, but the main part of the presentation today, the session, is going to be Yasin's presentation on FCA and regulation. We're also going to have them, I'll summarise at the end, but then we have this Q&A section. It'd be really great to get as much of your input as we possibly can at that time. Okay, so up onto the next slide here, just setting the scene. Now, ARENA have done a number of webinars to many different industries, and particularly automotive recently. And in the past, I've spent quite a lot of time talking about market trends. The points that are listed on the screen here, regulation, customer expectations, competition, all of which are on the increase and are bringing pressure on the industry. Frankly, it's an imperative to do more with less, to retain margins, to retain customers. Everything's becoming ever more competitive. Increases in regulation, well, these are somewhat inevitably happening, and they require both implementation work and management of those processes that you put in place to ensure you're compliant with regulation. And in particular, recently, we've seen the FCA start to bear their teeth a little bit in the automotive retail sector. So these regulations, these changes really are meaningful. But as I was thinking about this earlier, this is the sort of business as usual discussion that I would have been having in February. And right now, I feel that the situation is anything but business as usual in light of coronavirus. We're working from home. Much of our economic activity is unfortunately right now on pause. That's the reality of the situation. And there's considerable uncertainty about how long the current situation will last and what indeed the new normal will look like at the end of this. So that teases out a couple of key points, or pretty obvious points, really. What can we do in the short term to keep our businesses running, manage our cash flow, all those are the good things that we need to do? And how can we be best positioned for the upturn when it inevitably comes? Now, at the end, I'll mention we have some other ARENA webinars where we'll talk about lessons learned with regard to home working and some of the transacting digitally elements that we do. But right now, I'd like to just turn it back to today's topic, because this regulation element is not going to go away. It's definitely an area which we need to consider. And it's something that we can do now to prepare ourselves for that future upturn. So getting this right, we've got an opportunity to get this right now, make the changes that we need, and prepare ourselves when we start doing lots of business in volume again. So with that, I'll turn over to Yazin to talk about the main topic for today, which is the FCA regulation changes. Yes.
Thank you very much, Neil. Building on what Neil was saying, it's important to get these changes right now, but in order to get them right, you need to understand not only what they are, but where they come from, what the FCA's thinking is behind it, as well as what its intentions are for the industry. And we're going to be going through that today according to the agenda that I've set out here, talking first and foremost about the critical changes that are due to come to the motor finance industry around the prohibition on discretionary commissions, as well as their plans to amend disclosures that are sent to customers or conveyed to customers. We're going to be talking about the underlying themes and reasons for this, including the theme of treating customers fairly. We're also going to be looking at a broader view of what the FCA's intentions are for motor finance based on its communications to the industry, as well as underlying considerations of why it's made these changes in affordability and vulnerability assessments. Finally, we'll be looking at ways that the industry can respond and how it can project manage this, and we'll have some time at the end for Q&A as well. So starting off with the chronological order here, whereby we'll look at the FCA's consultation paper CP 1928, which was released in October of 2019, and it closed for consultation on 15th of January 2020. The FCA has been looking at the motor finance industry since 2017 in earnest, and it has done mystery shopper exercises as well as assessments of lenders and brokers to really understand not just their business habits, but also the industry itself, the culture, as well as some of the workings around commissions and how the interactions with customers work. So based on its findings, it found that where there were difference in charge or scaled commissions, so where the agreement between the lender and the broker of a finance arrangement involved the setting of a minimum or maximum interest rate, and the commission being based on a proportion of the difference between the actual and the set interest rate, or alternatively through a scale commission, which also varies on the basis of interest. They found that these interest rates were not actually attending to credit risk of the customers. So not attending to the ability for those customers to repay the loan, and there was a lot of discretion around how these were set. And the FCA found that these rates were being set in a way that remunerated the broker without actually evidencing a benefit to the customer. So they found that it wasn't actually giving them a good deal. And they're proposing to ban these commissions outright. They did consider having some kind of relaxed circumstances whereby if you could prove that there was a benefit to the customer, that the commission would remain. However, based on their study, they weren't able to find this. So there's going to be a complete prohibition on these types of commissions. The way they've worded it in their paper is around the total charge for credit as opposed to interest rate. And this is to prevent avoidance of the commission ban. The second component is around enhanced disclosure to customers. So two ways of protecting customers are to ban an activity that you find is harmful to them, which they're doing on one side. And the second is really to educate the customer more. So at present, under the FCA's rule book, there are disclosures that need to be made to customers on the type of transaction that's being given to them around car finance, as well as the commissions. What they found was that the information given to customers was insufficient to make them understand the risks involved, as well as what the benefits were for the broker if the commission were to go through. They also found that brokers were not giving sufficient information about the transaction to customers across all segments of the customer journey. So not just at the point of sale and recommending a product, but really during the financial promotion stage as well. So what the FCA is going to do is increase and improve these commissions, improve these disclosures, so that way customers have a fuller view of the type of transaction that they're engaging in. In terms of, yeah.
Sorry. Oh, yes, if I can just jump in there, just to put a little bit of extra colour around the automotive element of this, because one of the things I'm going to ask you shortly, what's the spread of behaviours look like at the FCA? But in the work that I do, working with process improvements within automotive and implementing document management solutions which implement those processes, I often get to walk through an operation and really get into the trenches and really see what it looks like on the shop floor, on the sales floor. And a couple of years ago, I had an interesting experience which relates to this, which is I was doing a walkthrough and I went to see one of the sales managers, used sales manager, a fairly large retailer. And I walked in, I literally said, "Hello, I'm Neil from Arena." And just as I was introducing myself, one of the sales guys came in and he said, "Hey, boss, have you got a minute?" to the sales manager, and I just sort of smiled and was quite happy to have a discussion and for me to listen. And the first thing was, "I've got a customer here who wants to buy this vehicle, but he wants to pay cash." And the instant reaction, even in front of myself as an unknown person, I mean, I could be an FCA mystery shopper at that point, was to call this customer a number of fairly flowery names, shall we say, for wanting to pay cash, which kind of highlighted to me just the sheer importance of the financial models within automotive, and also some of the motivations and drivers which are there to make use of these for not necessarily for the benefit of the customer, shall we say. So I'll ask you in a moment, what does the spread of behaviours look like? But the other interesting thing around this for me, which I just realised as you've been talking here, is that it was a pre-sales engagement where I was working with that customer. That customer, that organisation, didn't actually proceed with a project to implement some new processes because their management didn't perceive there was a problem to solve. So there's quite a disconnect there between shop floor and management perspective on that. So that's an example from my experience. But what's the spread of behaviours look like? I probably painted quite a bad one there. What's the spread look like in practice, do you think?
Yeah, and you hit really two really important points there, Neil. I think one is the first thing is the spread of behaviors. So I think, as you said, you could have been the FCA, you could have been a mystery shopper, and this is what the FCA did talk about in their consultation paper, was around there potentially being a lack of oversight by management of what brokers were doing on the floor, as well as their interactions with clients, which could lead to these type of unsavory moments, but also just a misunderstanding of what the actual objective of the customer is. The customer's objective is to buy an asset. The secondary ancillary component of it, which is the regulated activity, is the car finance component. So if you're making profit on the basis of the car finance, that's fine. The FCA is not against that. They did find that under 50% of the market were even using these interest linked rates. They found that most were using flat fee, and they were approving of that. But what they did find was that the behavior towards the customer by engaging this type of interest linked commission is not conducive to having an appropriate user experience, and is not conducive to the conduct that they expect regulated financial services firms across the industry. So not just motor finance, consumer credit, but investment space, all the way down to a pawnbroker. It really needs to be customer comes first, and you need to make sure that they have the best experience possible. I think that the second component really is around you can still make money on the basis of doing a commission. The rules themselves do not prohibit commissions which are enhanced or slightly more for the broker if the broker actually adds value to the type of assessment that they're doing on the customer. So if they're doing due diligence on the affordability impact on the customer and what kind of impact it's going to have on their finances, then they're going to get an improved commission for this because they're doing more work. And the FCA wants to see more of that. So they did see a spread of behaviors, both good practice as well as poor practice. They're trying to rectify the poor practice, but ultimately they're saying that the good practice should continue and should be built out in a more consistent and robust way. Hopefully that kind of answers your questions.
Yeah, thank you. I mean, one of the things I'm hearing there is that the FCA, they still want people to be able to make money. I think that's really important to you have to keep in mind as we go through this. It's almost, there's a lot of preventative stuff, but actually there's still an acceptance. Look, the motor trade is, they're providing a service and they should be remunerated for that. Yeah, thank you.
Exactly, yeah. The FCA is definitely not going on the lines of you shouldn't make money. And in terms of their timeline for these plan changes, implementation is scheduled for the beginning of Q2 2020. They haven't given a date yet, but when they do that, they will set up what's called a policy statement, which will indicate what the changes are in firm. So if there was any type of feedback during the consultation period that needs to be accounted for, then that will be brought out in this policy statement. 3 months after that policy statement comes in, the ban on commissions will take effect. So there is a lead-in or a buffer period to help firms come to grips with what the changes are and make the changes to their business models and their remuneration practices. With the disclosures, conversely, those take effect immediately upon publication. And that's because the FCA feels that firms are able to make those changes relatively quickly, and the changes compared to the ban on commissions are a lot more minor and a lot more manageable. After the commission ban comes into effect, the FCA's plan is to monitor 3 months after this what the effect of this is and whether there is compliance by the market with the commission ban as well as the enhanced disclosures. And then they've said in 2022 they're going to actually review the impact on customers. Now, I guess to head off with probably the question at the forefront of everybody's mind, what's going to happen given the current circumstances around coronavirus? Is this going to be delayed? Has there been any information from the FCA on this? The FCA has not said specifically that they're going to postpone any of these implementations. However, if I were a betting man, I would say that it might not come in the first day of Q2 2020. It might come in slightly later, but we are anticipating that these changes will still come in Q2 2020 because they've been discussed, because they've already been close to being set in stone, and because the FCA feels it is possible for firms to bring in this implementation once the policy statement is set out. Moving on to the next slide, we're going to talk a little bit about why the FCA is actually doing this action, more of the kind of underlying drivers for this. As I said from the outset, motor finance is ancillary to vehicle purchase. It's really about kind of the customer's intentions are to buy a vehicle, and the way in which firms in this space are able to make money is through the financing options. They did a review initially in March 2019 based on some questions they had for the industry in July of 2017. And these questions are really focused on kind of aspects of regulation which you see in other industries like banking or consumer credit. And the first is really around affordability. Affordability basically means that you're looking at what the impact of the transaction is on the customer in terms of their finances. Do they have to borrow more money in order to make payments, or what's the significance of the impact on their financial position? The FCA found that the focus by actors in the space was really more on credit risk rather than the impact that the repayments would have on the consumer. And this is a concern that they've had across various industries. The second is around conflicts of interest from the commission. So what the FCA has said is that if you have interest rate driven commissions, that they're costing customers, and brokers effectively have too much power to adjust these rates to improve commission without actually benefiting the customer. So conflict of interest is effectively where the financial interest of the firm is not in the same direction as the financial interest of the customer. So if you're trying to make money for yourself and it goes against the customer in a way that doesn't really have a benefit, so if you're making commission without doing additional due diligence or affordability assessments, and it's not linked to the credit risk of the customer, then there's a conflict of interest arising. So the FCA wanted to address this with its ban on the commissions. The third point is really around transparency and the information that you give to customers. Under FCA rules, communications to customers must be fair, clear, and not misleading. And many of you will know this if you've interacted with any financial promotions, and there's a lot of kind of rules around this already. Their findings were that brokers need to really consider whether the descriptions that they have of the finance options are overemphasizing the benefits without sufficiently indicating the risk to the customer. So not just the commission component, but also the risk of not repayment, what can happen to you, what happens to the asset as well. The final point is really around lender controls. So the FCA felt from its review that lenders were relying a lot on contracts, which they found to be appropriate in terms of how they were designed. They were relying a lot on contractual terms to say that brokers would abide by those conditions that were set out in the contracts without actually verifying whether brokers were actually doing this. So they were suggesting there should be more monitoring of broker conduct as well as on-site visits to ensure compliance. It's the same same kind of method that audit firms would kind of use to test any controls, is that, okay, you say that you do X, but how do you know in practice that this is being done? Can we see some evidence around that? And that's really what the FCA is looking to see and hoping to see develop in this space.
Okay, yeah, there's a couple of questions around the sort of the information to consumers and a little bit of the process there, because speaking from personal experience, buying a car is quite an emotional process. The sweets in the sweet shop factor to a certain elements. I certainly get quite giddy about it and think, okay, well, yeah, within my budget that I've set, what can I get? But when you look at the process, sometimes you find that it's almost a two-stage process. There's a discussion about the vehicle, the asset that you're wanting to buy, and you end up thinking, will that fit within my budget? But what I find in the motor industry as well is that there's almost a two-stage element to it, because when you've selected on the vehicle itself, then there are often additional products that you might want. I'm thinking here of things like paint protection and gap insurance and so on. Some really quite important things, but you sort of consider once you've kind of set the financial parameters for the vehicle itself. And I wonder if any of that was something that the FCA had teased out. And I have a second question about demands and needs docs, but if you just come back on what you think about that two-stage process element and the information aspect.
Yeah, so it's an important point around it is a bit of an emotional buy sometimes when you buy an asset. And the FCA did consider the fact that the motor finance industry, even though they would be losing some money by not being able to engage with these commissions, they could still make money by add-ons or increasing the asset prices as well. So they did find that there is a way for them to financially still benefit from this. I think another component is, does the customer actually need or can they afford the additional insurance or the additional add-ons that you're offering them? And this is an important consideration for firms to consider when engaging with the customer. Does it make sense for them, and is it something they really want? Which kind of comes down to sales culture. So if firms are pushing buyers into a personal contract purchase arrangement rather than a traditional hire purchase arrangement, when this isn't really the buyer's intentions, this kind of touches on sales culture, which can lead to negative outcomes. But importantly to note, even though these changes are around commissions and disclosures, they're not necessarily mitigating against poor sales practices. So this is something important to note when you're kind of looking at the trading floor as well.
Yeah, I mean, that's something that we help our customers implement in terms of process, because certainly some of the insurance products, there has to be a period before you can even start that discussion with the customer, unless the customer wants to have that discussion there and then. And we can and do build systems which enforce those time periods to manage the practice and so on. My other thoughts were around demands and needs documents, which are specific process that the salesperson will go through with the customer to understand what it is that customer needs in terms of finance products. And I personally, when I've been working through this with retailers, I found again a spread of behaviours. In some cases, the first thing that you do when you engage with that organisation is you go through a demands and needs document process and sign off on that almost before you're even talking about the product, which can be a little bit off-putting sometimes actually as a customer. In other cases, I've seen a case where demands and needs documents were being filled out and signed by the customer at the point of handing over the car, which for me is after the horse has bolted. Everything has been done up till that point, and that is then a regulation tick box, and it's not serving its purpose. I just wonder if you had any views or comments around that kind of stuff.
Yeah, I mean, it's an important point because it would kind of kill the sales process if it were so regimented by the FCA that it said exactly all the steps you need to take from point A to point Z. And it wouldn't leave much discretion at all for someone on the floor or any firm to actually help sell a car with any type of finance option attached to it, because it would be dictated by the regulator, which is not what they're trying to do. But it's important point that if you're going to make that assessment process of does the customer have the means to take on the option, as well as what are the add-ons that are relevant to them, it shouldn't be just a tick box at the end of the sales process. It should be built into it. And how firms do this is really left up to the market. The FCA is not prescribing a particular method of this, and they don't tend to do that either. What they will do when they do review this 3 months after the regime fully kicks in is they will try to assess whether these methods of actually looking at user experience and focusing on customer experience, as well as looking at recurring custom, whether these are actually still in line with their expectations for the industry.
Okay, thank you.
One of the significant underlying themes for this, if you look through the consultation paper, as well as any communications from the FCA, is around treating customers fairly. Now, treating customers fairly is a concept or a principle that gets bandied around a lot across different industries within financial services, and it's really around building the customer at the heart of your business, making sure that they are attended to first and foremost, that they have the best deals available, and that their interests are aligned with yours. For motor finance, what the FCA is looking at is ensuring consumer confidence. And by this, they're trying to say that if commissions aren't actually beneficial to customers and they're not employed in a risk-related perspective, absent a commercial purpose, it can diminish confidence in the industry. What the FCA is trying to say, if customers realize that they're not getting the best deal, it means that they are not going to come back to the industry, or they're going to issue complaints about the activities of certain actors in the industry. That's one component, is around customer confidence. The second is around, and we touched on it earlier, making an informed customer. So if you go into buy a vehicle and you don't have full information on the impact of that finance in terms of your finances, as well as the impact it has in terms of commission, you have an uninformed customer. And treating customers fairly is born out of these enhanced disclosure requirements to ensure that you have customers who can make educated decisions on finance options, which I appreciate from an industry perspective. It's a bit frustrating to have to play the role of both nanny as well as a financial services institution, and you're trying to educate your customer base a little bit. But what the regulator is trying to say is that a more informed customer is able to engage in more informed business, and this is not going against the idea of profit or making a profit on the basis of a customer's finance options.
Okay, yes. It's not the first industry that the FCA has taken this kind of interest into and talked about. So just some of the commercial realities here that the FCA is demonstrating are good. What kind of upsides or benefits have the FCA seen in other industries where they've gone maybe through a similar kind of regulatory experience and come out the other side, or be a few years further down the line?
Yeah, and very good point. Treating customers fairly has been employed in other industries. So the first example I have off the top of my head would be around the investment space. So MiFID II, the Markets and Financial Instruments Directive, came in, which impacted banks and investment firms. And one of the key components of it was costs and charges. And this is really around customers knowing how much they're going to be paying for an investment service. So if you invest in a fund, or you are a client of a wealth manager, how much you're going to be paying over time. So the amount you're paying in January could change based on the amount that is actually within the fund, or how much you've invested, or other considerations such as fees that are being paid to brokers. And the FCA said you need to improve transparency here, and what you have is a more uniform and transparent environment where the customer really can understand how much is paying. But it can also differentiate between market participants and say, actually, I think that I'm not paying the best commissions and best rates here. I'm going to move to a competitor because I think it's better value for money. The second is really in consumer credit, where the FCA has tried to use TCF as a basis for affordability. And they came up with a policy statement in July of 2018. And what this has done is it's helped poor performers, and it again has allowed consumer credit firms who are taking this seriously and building affordability into their assessment process, building that TCF component into the heart of their business, as standing out from the rest of the crowd. And this builds consumer confidence in the industry, and it also, again, helps the consumer become more educated, allows them to take appropriate decisions based on risk as well as benefits.
Okay, so I mean that feels like you're building customer confidence in the industry is a great thing, but also as an individual business, you're building a sustainable, quote, good business, which should lead to repeat business from loyal customers who feel that they got a good deal, knew what they were getting into, didn't have any surprises, and therefore next time they want a vehicle, they're going to come back. You know, that's the objective for all of us.
Yeah, exactly. So we've talked about what the changes are for motor finance in terms of disclosures as well as commission ban and why we have these changes. And playing into this, it's important to talk about a little bit of a more bird's eye view of the FCA's intentions for motor finance. So they did release a motor finance strategy letter, portfolio strategy in 20th of January this year. And they talked a bit about the components that we've already talked about already, so around disclosures as well as the commissions, but there's some broader themes which are important to address here. So they looked at what we consider key drivers of harm for the industry. So what they want innovation in all industries, but what they want innovation to consider is this innovation beneficial for a customer or client? Does it consider affordability? And then they also looked at it from a prudential perspective, which we'll get into in a second. The second component around key drivers of harm is around the conflicts of interest generated by commissions to interest rates, which we've already discussed. And the third is around treating customers fairly. And this is really around the affordability piece, which we'll go into in more detail in a couple slides. But it's important to consider from the FCA's perspective, this is such a consistent theme across all of its publications, as well as its interaction with the market and its expectations of actors in the market, that it is really worth considering if your policies, procedures, as well as your setup and monitoring is sufficient to ensure that affordability assessments are being made and that they are sufficient for the products that you're engaging on. So the FCA is going to be engaging firms to understand the harms that are potentially there in the industry and to clarify its expectations as well, because it does appreciate that if it releases one paper once a year, it might not be sufficient to help firms understand what its expectations are. As I said a little bit earlier, though, the FCA is not necessarily looking to prescribe to businesses how they should run their business. They are setting expectations, but they will leave it to the market to kind of meet those expectations. Then they will make an assessment of what is good practice and poor practice, and they will allow you to amend your systems accordingly. They want motor finance firms to put customers at the heart of their business, and they don't feel that profit should come before the interests of customers. It can be completely aligned with them. The second component, which is important to note as well, I know that we're kind of in the coronavirus phase of understanding the impact that it has on business, but there's also Brexit to consider as well. And they want firms to be planning for the impact that Brexit is going to have on them or has had on them, as well as the impact it has had on their business models. So in terms of the focus areas and expectations, I set them out on the right of the slide. The first is really around business model changes. So what the FCA is saying here is that if you are a firm that is going to innovate, potentially off the back of these commission changes or disclosure arrangements, it's perfectly fine to do so, but you really need to consider how it's going to impact your business model, and you don't want to be moving into areas that you don't have the expertise in or the controls to mitigate. It does have some arrangements whereby you can innovate in a more, let's say, forgiving environment. So they have what's called a regulatory sandbox. So if you have something which is completely new to regulation, you could go to the FCA and seek to test out these ideas there. But for the purposes of the motor finance industry, they really just want to make sure that firms understand how their business model is going to change off the back of these changes. And if it is going to change, that it's not trying to just circumvent the rules, that they really understand what the controls are to help affect these changes. The second point is around the prudential risk. The FCA did a review of motor finance firms, and they found that most of them were sufficiently capitalized to mitigate the risk of falling asset prices. But what they wanted to ensure is that this risk is still assessed on an ongoing basis. So if the residual car value drops below what was anticipated, are you buffering appropriately? And is the valuation process that you're using appropriate over time? So if the price does go down too much, do you need to revisit your valuation process? So that's a prudential consideration. But overall, the FCA found that firms were taking this fairly seriously. Commissions, we've already discussed in a fair amount of detail. So I'm going to go to affordability, the penultimate point. This is really around kind of the firm, if it experiences growing arrears, it's fine to look at affordability on a case-by-case basis, but you do need to consider kind of root cause analyses. Why are you engaging in these financial arrangements if you are well aware that firms cannot actually undertake, that customers cannot undertake the payments that are required? And the final point is really around regulatory permissions and reporting. So if you have permissions on your FCA authorization that you don't use, the FCA says that you should not have these permissions at all, you should cancel them. And part of the reason is, and they think they came up on this on the basis of debt management services, that you should submit to them what your capital resources are rather than submitting a nil return. So I think they found on the basis of some of the returns that people were giving that they didn't understand what permissions they had. And so if you have permissions that you're not using, cancel them. And if you do have permissions in debt management services, make sure that you are submitting your accurate prudential amounts. Developing on the points that we've talked about around affordability, both from the perspective of what the changes are for motor finance based on the consultation paper by the FCA, as well as its agenda for the motor finance industry and its portfolio sector assessment. We're going to talk a little bit about what the expectations are around affordability and vulnerability by extension. So affordability is the risk the customer cannot repay as per the terms of the agreement without adverse impact of further borrowing. And it's a tough one to assess sometimes, in part because firms don't always have sufficient information, or there's reticence around information that's actually being supplied. But ultimately, the FCA wants firms to consider why you're suggesting a product or lending sums to parties who cannot pay without becoming uncomfortable. The FCA is really looking to understand systemic risk of lending to parties who cannot pay and how defaults impact the viability of financial services, helping people meet their needs more broadly. The customer's ability to make payments needs to fit within their creditworthiness. And the FCA doesn't have a set checklist for how to do this, but they do have some considerations that you should look at. Look at customers' individual income sources, look at their outgoings, as well as more broadly individual circumstances. What we tend to see is an affordability scorecard system. So these are metrics against which it's commensurate with the risk posed by the loan. And if you do find that you are running into affordability issues, not just on a case-by-case basis, but more systematically, it's important to have a root cause analysis to assess what the true problems are with this, and do we need a revamp to our business model. In terms of vulnerability, this is a really kind of important component right now. We've heard a lot about vulnerable persons from a health perspective recently, but the FCA does remind firms that up to 50% of adults can display one or more characteristics of being potentially vulnerable. And this is a difference between permanent and current vulnerability. So let's say a physical disability versus losing a loved one. I mean, there's a potential for vulnerability, and there's an actual vulnerability, and then there's a future vulnerability. So it really is a fluid environment, which makes it difficult for firms to assess this once and then not look at it again and again over the course of a relationship with a customer. So the drivers of vulnerability are kind of broken down to 4 parts. There's health, there are life events like bereavement, there's resilience, so withstanding financial or emotional shocks, and there's capability in terms of your knowledge and confidence in managing money or in assessing the impact that an engagement is going to have on your finances. The FCA has released some guidance on this, which I encourage firms to look at. And there's a balance between assessing vulnerability and then potentially being a little bit too intrusive in that assessment. And I would be kind of at odds with going in to purchase an asset and being asked for my medical records to ascertain whether or not I'm a vulnerable customer. So it's not asking firms to go to that length, but it's also hasn't suggested to firms a particular way of doing this, apart from to be aware of the fact that there are vulnerable circumstances in people's lives which arise over the course of the lifetime of an arrangement. In terms of the impact it's going to have on firms, they need to have staff who are sufficiently knowledgeable of the vulnerability and affordability requirements, and they need to have the confidence to make judgments. And that really does come down to understanding the firm policy on these arrangements, as well as training staff and sufficiently training them and ensuring that that training is tested and verified to make sure that you have a consistent, firm way of approaching affordability as well as vulnerability.
Oh, yes, I was going to ask if there were a list of key vulnerabilities that the FCA is expecting a retailer to be considering and what the retailer should look at. But obviously, as you just said, they're not being prescriptive around that or saying, here's your checklist. They're actually making it a risk-based process that the retailer has to go through. But you also mentioned that there's some other guidance notes there, so perhaps we can actually include that as a follow-up article following this webinar, just to signpost people to that. But it is a pretty complex issue, and just for those listening, we do have a second webinar coming towards the end of April, and this is potentially one of the areas that we could drill into. So if people just want to post some questions or post on the chat if this is the area that you'd like to drill into, we can think about expanding that out in the next webinar, because I think it's a key and complex area.
Yeah, definitely agree. It's not the most straightforward area, and even though the FCA has set out guidance around this, it's not done in a way that's as prescriptive as some firms want. And the FCA does understand this because they have said that they want to clarify expectations. It might not be in the way that you want it. It might not be as set out in terms of these are the 10 things that you need to look at, but it is making you think about where the risks are to your business in terms of the drivers of vulnerability, which we talked about, as well as the impact it has on practical actions. So how do you build this into the product and service design of your firm? How do you focus on customer service as well and communications? What's the user experience like, and what's the experience like for customers who are coming in to buy a car and engaging in motor finance as a part of that? And what kind of information are you taking from them, and is it done on a consistent basis? And are you reviewing this over time? So let's say there's a life event which makes you believe or lets you reasonably conclude that there's a vulnerable person, and what is the impact that repayment is going to have on this individual, as well as how are you going to allay potentially the impact while still being able to turn a profit, because the FCA expects you to be able to run a business as well. In terms of ways to respond, we've set out some considerations here as a business you're actually looking to implement these changes by the FCA, as well as potentially review your current arrangements in light of the FCA's intention for the motor finance industry. I think that the first point is really around not over-engineering the process too much. The FCA is not looking for firms to completely reinvent themselves. What they are looking for is for compliance with an objective. The objective being treating customers fairly, the objective being mitigating conflicts of interest, the objective being to look at customers' affordability while making these assessments as to how we can profit from these finance arrangements. Keep these things simple in terms of your operational kind of process. Don't try and get everyone under the sun to advise you on different components. It's really just around ensuring that you have a consistent approach to addressing these regulatory changes. And it may be that you've done this before for other regulatory implementation, but really just kind of keeping the process as simple and as streamlined as possible. The second point is around ensuring that relevant areas of the business are participating in the planning, preparation, and implementation. So this is to say that you're involving management, but you're also involving brokers potentially on the floor, sales staff, as well as operations staff, to really get their input on what's going on at the moment in your business and how are these changes going to be impacting your business. So you'll do a compliance risk assessment to understand what the inherent risk is to your business of non-compliance. You'll look at the controls that you have in place at the moment, and then you'll come up with a residual risk in terms of, do we feel that there's a genuine risk of non-compliance or falling afoul of the FCA's principles, which are effectively the treating customer fairly principle. And in order to do that effectively, you can't just have it driven by compliance. You can't just have it driven by management. It really needs to be an inclusive and involved process by components of your business that are going to be impacted by these changes. The third point is really around involving the business once the changes actually go live. A lot of firms, when it comes down to compliance, will look to compliance to not just lead the changes, but also to kind of fully manage the monitoring aspects of them, as well as changes to policy, procedure, and reporting. And we tend to find that this process doesn't actually allow compliance to have sufficient oversight of the business, and it doesn't allow the business to really give compliance its input about how the changes are impacting it. So it might be just on the basis of what the FCA was saying around lender controls relying too much on contract. It might be that you have individuals going on site to brokers to assess their compliance, but that doesn't mean that they need to be compliance individuals. They can be relevant and skilled individuals in other parts of the business who can report into compliance and work in junction with them to ensure that you have sufficient oversight, as well as an understanding of how your regulatory risk is being managed. The final point is really around clear communication to staff. And this is critical because any type of significant change that comes into a business, particularly when it comes down to prohibitions of commissions, which impact people's remuneration, that needs to be clearly conveyed to staff who are going to be impacted, not just from a policy level, but for the individuals that are going to be impacted by these commission changes. So ensuring that they know when these changes are coming in, and ensure that there's a build-up time so that they can get used to how the changes to sales and sales tactics are going to come about. The other component is training. So some firms use computer-based training, some use in-person training. As long as it's effective and as long as there's a way to not only verify that your staff have undertaken training, but also that they really understand the rules and understand the impact it's going to have on the business and their day-to-day operations. That's really critical in ensuring compliance with this regime, as well as any other regulatory changes that ever come to your business.
Okay, thanks, Jess. Just want to jump in with a couple of things there. I mean, I really like the idea of the communication and baking in these good practices into your standard operating processes. It's something we do a lot with Arena's MStore document management product, and our workflow processes is automating as much as we possibly can, but baking in and controlling and prompting rather than necessarily dictating. So people are still making intelligent decisions. They're not just being told what to do by the computer. And a lot of this, you get both good communication with the teams and good process mapping of what's really happening as you go through the process of implementing that kind of solution. So it's a nice way to uncover what's going on and communicate communicate what's right. So I feel that's an area that I'm really excited to work with in automotive. My question, you mentioned FCA consequences and penalties for poor practice. What do they look like? What's the downside if you don't do anything, I suppose I'm saying?
Yeah, I mean, I don't want this to be like a fear-mongering part of the presentation, but the obvious ones are around around the financial implications. Failure to comply with regulatory changes. The way in which the FCA looks at it is they do kind of give you an opportunity to rectify this. So what they do is they'll do as part of a thematic review, they'll assess different players in the industry, report on them, look at good and bad practice, and then they will communicate with you if they found that you had poor practice. Listen, this needs to be changed, and these are the changes we want you to do. They'll give you a time period within which to make those changes, and if you don't, it could lead to what's called a Section 166, which is from FSMA, and this is effectively where you have to appoint a skilled person, so a consultancy firm or a law firm or an advisor to come in and assess your compliance with the regime. If those findings are adverse, it could lead to financial implications, a fine for the business. It could also lead to individual accountability. This is a subject for the next webinar we're giving in April around SMCR, but because of the introduction of this accountability regime, it does mean that senior managers who are responsible for certain business lines could be on the hook if the business fails to comply with regulatory expectations. And this could lead to individual fines as well as a ban from the industry. And the other component is reputational, really. So if you're always in the FCA kind of highlight reel of not having complied with its expectations, it reduces customer confidence in your ability to give it a fair deal. And it is bad press. I think the example that we have is Money Barn around the fine that they were given by the FCA, as well as the 30 million that they were trying to do in terms of redress for customers for having not really engaged with the affordability assessments appropriately and having demanded payments which were not suitable or appropriate given the financial circumstances of customers. So, I mean, these kind of, not all press is good press, and these are some considerations to have in the back of your mind when you're doing this assessment. On the flip side, though, I mean, if you can really comply with these conditions from the outset, bake them into your process, you will be a standout, and you will be a kind of an industry leader in terms of your assessment of user experience, as well as understanding of what the regulator is expecting of you and how it expects your business to operate.
Okay, that's great. I mean, can't stress too much. This is not all about kind of the negative and the downside. We're talking about building good businesses, having good practices, and getting confident customers here. And I think it was really interesting, though, you said, you don't necessarily need to get every advisor under the sun. You don't need, keep things possible, keep it appropriate, and so on. I think that's probably just neat if you could just tell us a little bit about Connexo and the services that you provide to help people get through this.
Sure. So in terms of what we can do for firms who are trying to understand regulatory implications for the business, we help firms process regulatory changes. So not just kind of understanding what the text is in the legislation or the FCA handbook, but really the impact it's going to have from what we would call a design as well as an operational perspective. So from a design, you look at policies, procedures, you look at your training programs, but from an operational perspective, you look at the impact it will have on the business in terms of practical components. You look at the type of reporting that's required for this type of change to go through and to ensure compliance. And you try to really make sure that the business can manage the change going forward if there are further changes. And we do also look at components of governance as well. So not just senior managers and certification regime, which we'll talk about in the next webinar and its impact on motor finance specifically, but we're looking at how oversight works in terms of the terms of reference for your committees, as well as the sufficiency of the management information that you're getting to ensure that you know what's going on in your business. And the other area we also look at is around kind of a broader compliance review. So we can help firms in terms of processing reg changes and advise on procedural amendments and operational impact. But if firms have already done this work themselves and they don't need any advice on this, we can help give assurance on it as well. as well as building out monitoring programs. And if firms want, we also have helped them with preparing themselves in the event of a regulatory visit, whether it's a thematic review or a more serious style of review, so a mock regulatory audit, just to help them understand what the FCA's expectations are and if they are going to be prepared as a business to really understand their compliance with these expectations.
Okay, thank you. Okay, so we've got about 5 minutes left, and I want to use as much of that as possible for Q&A type discussions here. Make the most of Yaz's time while we've got him. But I did just want to wrap up with just a couple of takeaways that I've got there. You know, it's important to consider your processes, and I think get into the day-to-day practices, what really happens in front of the customer. Number two, seek assistance if needed. It can be a complex process, but seek appropriate levels of assistance. You know, it's not an army of consultants required here, hopefully. In terms of third, keep it simple, keep it appropriate. This is about treating customers fairly. And I think a good guide might actually put yourselves in the shoes of the customer. How would you feel? How would you feel if you'd be treated by your processes? Would that sit well? And the fourth one, I can't stress this one too much, is put customers at the heart of your business. It's what the FCA is asking for. It's what we're all asking for, what we want to be doing. So I think that those are my little takeaways that I've jotted down there. I'm sure other people have got lots more. So we've just got a few minutes. The first one is drawing together a couple of questions. We've talked about assessing customers' affordability, the customer's ability to afford a particular product. In terms of this FCA regulation, apart from the retailers, who assesses that? Who makes a judgment on that to compare with what practice is actually going on? Is there an independent authority? Does the FCA have people who will do that and tell you are right?
So I guess just to understand that question, it's who assesses the assessor, right? So who's making the assessment that affordability is actually being considered? Is that correct?
That's right, yes.
Yeah, so the way in which the FCA looks at it is based on the information that they set out in their guidance. They expect firms to build this into their process and procedure, and then what they will do is they will look at the implementation of this process and procedure in practice by doing either a thematic review, a targeted visit to a firm, or by doing a mystery shopper exercises to see if the customer is actually going to be assessed on the basis of affordability. And they will look at whether or not guidance that they've issued is being applied consistently as well as accurately. So it's not like there's an independent body that sits away from the FCA that will look at this. They will look at the implication it has on the individual customer's finances as well as their ability to repay, and they will be looking at it more broadly from a policy perspective as well to see if those policies have been amended in light of affordability. Hopefully that answers the question.
Yes, I think so. Okay, thank you. We're nearly up to time now, but I'm going to let us run over by a couple of minutes because we just got some interesting questions coming in here. It's something you touched on earlier, but will the FCA change their timeline in light of coronavirus? And a follow-up question to that, how would that be communicated, and how would interested parties, the automotive retailers, be aware of what's going on? Where can they go to look?
Yeah, so I think that the FCA has not said anything at the moment, but it might be that they come up with this guidance in the latter half of Q2 rather than the earlier half. If you do want to kind of be kept up to date with this, the FCA website is generally speaking kept up to date, even though despite the coronavirus situation, they have been updating the website with information on whether or not they're going to be making any changes to regulatory implementation as well as the supervisory regime. And if they do not kind of update their website, they will end up communicating this to relevant market participants through a letter as well. So there are ways to be kept up to date for your own monitoring, and the FCA will make sure that firms are aware of this.
Good, thank you. Okay, just final question before we move to wrap up here. How do these changes impact or link with distance selling regulations, if at all?
So it's a good question. I think the thing to consider is that it's the FCA's changes for commissions as well as the disclosures, as well as its agenda for motor finance, are agnostic as to the method of selling. So even though they may have done mystery shopper exercises on a particular dealership, they have also done some work online as well. So if you are kind of engaged more on the online focus of distribution as well as engaging in regular activity, there are a set of rules that are specific to that. But these rules around treating customers fairly, prohibition on commissions, as well as improved disclosure, those will still apply to you. And the FCA will also be monitoring these areas for compliance in future when they do their assessment process. So there is some kind of impact across the board, irrespective of the medium by which you communicate with customers and sell your products.
Sure, okay. I guess that given the current situation we're in, lots of people will be thinking about transacting online, which brings with it its own challenges in terms of around the communication with the customer, and also actually, the customer's not in front of the asset that they're buying. They're going to need those. They can't verify the quality of the product at that time, so they're going to need to have accurate descriptions around mileage, state specification, all that kind of stuff. So all of this rolls together. There's quite a piece of work to do around transacting online. Okay, well, I'm going to wrap up the questions there. We do have a few other questions coming through, and what we'll look at doing is maybe a blog article or something like that where we can actually cover some of the other questions and the questions that come out of our next webinar, which will be on the 30th of April. So this is going to be part 2 of this, and how to avoid giving rise to conflicts of interest, drill into that particular area. So we'll do a little bit of a recap, but it's another session. It complements this session, so it's worth enlisting for that session as well as this one. And also, please do keep a lookout for other arena website webinars which we're going to run based on your feedback today, which largely the poll matches what we thought would be some useful stuff for the industry. So we will get those advertised out to the market. So we've just run over a couple of minutes. Sorry about that. But I think everybody will like to just join in. A big thanks to Yasin for giving his time today and producing such an informative presentation. I'd like to say thank you to everybody for attending. Wish you all a good afternoon, and please keep safe and healthy. Thank you.
Thanks, everyone. Have a good day.